Tonight we've done a lot in planning. We've done a lot of planning. We've done a lot in marketing, which is those 4 P's of marketing: position, distribution, all that sort of stuff. Promotion with inbound marketing and so forth. We're now going to go and look at legals, and then from legals into finance accounting. And running parallel with that, we're going to try and keep up our social media web world as well on a Thursday. So this is the first of sort of the important legal things that you need to consider for your business, and that is the business structure. So this week we're going to be looking at, tonight I hope to be able to do business structure and registering for ABN and GST. I hope to be able to do that tonight. We'll do a bit of laws on introduction to laws on Thursday, and we'll go back into trying to develop more. I want to get you guys more active on the keyboards doing stuff in social media. At least even going and look at Owen's core stuff and upvoting it. Because when he gets an upvote, he gets 10 credit points, which allows him to promote stuff. So come on, let's go and support him. And when Dan starts finally writing about Aeropress and answering questions, we can go and upvote him as well. Okay, this might hurt. Just hold tight, all right? This gets a little bit hairy, but I think you'll be okay. So business. In accounting, business is always a separate entity. I know we're talking about Dan's business and we're talking about Michael's business, but in accounting we see them as 2 completely different things. We see Dan and his life and his assets, and we see the business and its life and its assets. In accounting we see them as 2 separate entities. So while don't go looking at sort of my business, don't go getting confused with that, particularly with accounting. You've got to see them as 2 separate entities. But not always, even though accountants see the 2 as separate entities, the law doesn't. The law sometimes sees the 2 as 1. So even though you set up a sole trader, for instance, you say, this is my sole trading business and this is me, that's true in accounting. Your accountant will tell you that. Your accountant will create books of accounts for your business and for you. But when you go to see the law, you are the small business in that case. And when someone sues you, they don't sue your business, they sue you. Because you and your business are one under that structure. So we're just going to go through a couple of things. First of all, creating an entity. And this is a really sort of difficult thing to understand, but an entity is basically a living or non-living thing that has a distinct and separate independent existence. Like we all in this room have obviously a distinct and independent existence. When we get into the business structures, not every business structure has a distinct, separate legal entity. They might have that accounting entity, 100%. Even your small business has an accounting entity, but not all business structures have a separate legal entity. One that obviously does is a company. Once you create a company, you actually create a separate person. Talking about creating existence, under law you create something that can be sued, can sue people, can sign documents in its own right. But under most of the other structures, it's not true. It's actually you at the back of it. So a legal entity can sue or be sued. It can write contracts in its own name. And every business must assume a legal entity of some sort. So while your small business, your sole proprietary business is a separate accounting entity, the law sees you and your small sole trader business as one legal entity. So you can't hide behind your business when it comes to if you've got I get this confused, when you've got a sole proprietor business. Regardless of the legal status, accounting treats the owner of the business as 2 separate entities. So just sort of try to keep that in mind as we zip along here. The trouble with what you're about to get into with legal business structures is that every law looks at your business structure differently. In terms of legal entity, sole trader, that's where you just go out tomorrow and put up trade under your own name and start doing things. You haven't created another legal entity. The legal entity is still you. In terms of accounting entity, yes, you've created a separate accounting entity. In terms of a tax entity, no, you haven't created a separate tax entity. That tax that's owing on that business is still owed by you. So you haven't created that. And so you have to do tax returns for the owner of the business and tax instalments, which we'll talk about in a minute. If you set up a partnership, which is another structure, why isn't this screen? Can you control it? It looks good on yours, we just can't get it here. Hang on. Yeah, sort of. Under a partnership, it's not a legal entity, it is an accounting entity, and it is a tax entity. A partnership has to put in a tax return. The sole proprietor business, oh, thanks, Phil, doesn't have to. When you come to a company, it is a separate legal entity, it is a separate accounting entity, it is a separate tax entity, and it has to do company tax returns, asset annual returns, tax returns for each of the shareholders. It has to pay PAYG. A trust is another form of legal entity. It's not a legal entity in its own right, but it is a separate accounting area. It is a tax entity, and there's a whole lot of stuff there that I can't read. You can read it later. You'll need to download this set of PowerPoints because this is a really important. These are really important things to understand, and it's quite complicated. But anyway, by the end of the night, I hope that you'll have a pretty good understanding of it. So here are our 4 choices. All of you that are going to go into business, you've got 4 choices in Australia. Other countries have different structures, but in Australia, this is your choice. Sole trader, partnership, proprietary limited company, or a trust. A sole trader is an individual who runs a business solely by themselves. It's not a legal entity. But in other words, if you get sued as a sole trader, you are the one being sued. It's your assets that are on the line. Your house, your car, your kids, all on the line. Under a partnership, it's where 2 or more individuals with the intention to share profit. You don't create a legal entity with a partnership. You do create tax obligations in terms of tax returns, but it's not a legal entity. The individual partners are the legal entity. And one of the problems with a partnership is that the debts of one partner can be sued by the other. People can sue you for other partners' actions and other partners' debt. So you sign up with a partner, you go into partnership, it's all very clear. They go and sign up something, and then they disappear to Fiji. There's a nice little Pizza Hut, between Suva. I'll tell you this, between Suva and Nandi. If you get there, no one will ever find you there. Why I know that? Because I've sat there, and I've thought that thought. No one will ever find us here. If your partner ever ends up there, and they can't find them, the trouble is they just sue you, no problem. Because under a partnership, you are liable for the debts of the other partner, because you've gone into business under that arrangement. Proprietary limited company, that's where you actually create a separate entity. You talk about creating existence, you actually create, in law, an entity that can operate in its own right, almost living and breathing. To do that, you've got to obviously go through a certain creation process, but you do create a new legal entity. Discretionary trusts, really hard to understand, and I'll have a go on the whiteboard later to show you how this works. It's a relationship where a trustee carries on a business for beneficiaries. It's not a legal entity, and it's an arrangement, where an arrangement is set so that someone is conducting the business, but they're not the actual owner. They're doing it on behalf of owners. And it's one of the best structures for setting up to share profit and for protecting assets. Do you operate under a trust? I'd be surprised that your accountant hasn't set you up in a trust.
Oh, the plantation.
Yeah, the plantation.
Oh, that's all trust.
Yeah. Most businesses get to a certain point and the accountant says, come here, we need to put you into a trust. Yeah. Because of the...
legal nightmare.
Yeah, well, the accountants do it because they earn good money out of it, but it actually is one of the best forms of protection in terms of assets and one of the best ways to distribute profits from a company. But there's none of these things, some of these things have got advantages, and obviously they all have disadvantages. You've got to decide which one best suits you now, which one best suits you in the future, which one you think you should go and invest in. So that's what we're going to cover tonight. I don't know why that line was there, but anyway. So there's a lot of, so in choosing, you've got 4, right? So tonight you've got to choose one of those 4. Which one are you going to choose? I don't know. These are the sort of things you need to consider. Your available capital. If you've got plenty of money, please go create a discretionary trust. If capital is not a problem for you, that's a really great place to start. Business time frame. If you're going to sort of go and just do something at the Easter show, don't go and create a trust and all this legal nightmare. Just go and operate as a sole trader, go out there, make your money, close it up, and be on. If it's event only, you know, if it's a short-term thing you're doing, let's not go and spend all of the available cash in setting up a structure. Commitment. If you're just doing the test phase, maybe in your test phase, like that proof of concept phase, you're going to go out as a sole trader because all you're trying to do is prove something. Once it's proven, then you might come back. You know, you might run the first class or two and just test it, and then you say, this actually could work, and then you get a more serious structure. Your current tax status. You might already have significant income, significant assets, and all this sort of stuff, and you're going into business. Well, that's going to colour the type of business structure you're going to set up. You know, if you do have a lot of personal assets, yep, a lot to consider there. You're heading towards the company trust sort of end of the spectrum. If you've got a profit expectation, if you think it's going to make a lot of money, this idea, you need to again be positioning yourself for those tax effective end of the business, which is the company and the trust. If your profit expectations say, look, this business is only ever going to pay wages, I know that, or maybe you don't have to go and invest at that end of it. The number of investors, if it's just you, well, you can entertain the idea of a sole trader. If you've got more than you've got to think about, are we going to do it as a trust or are we going to do it as a company? So again, you've got to consider that. Future growth potential, you know, can this go into a franchise later on? Or maybe you want to start getting a companies right at the start to start building that credibility, start building that sort of, this business has been trading for 4 years and now we're franchising. You don't want to have it so that, hi, we're wanting to sell a franchise and we just incorporated last year to take advantage. Doesn't really look good. You know, if you have got an idea of franchising, maybe you'll start as a company right at the first. And the type of business. If your business is a very, if a lot of people sue the sort of business you're in, I don't know, you know, something in the medical field or something like that, something that has a high potential for being sued, then you need to be thinking seriously towards those structures that are good protection, which is towards the company and the trust. If you're not in a business that gets sued a lot, well, you know, maybe you can take the risk on sole trader and that end. So these are all the things we're going to consider, and I've got a worksheet that actually can help you by ticking boxes. You can sort of work out what you should be doing. Let's run through a few. Just look at the advantages and disadvantages of each structure. So one of the great advantages of a sole trader is you can start tomorrow as a sole trader. You go out and trade under your own name. You don't even have to register your business name because you're trading under your own name. You can be in business tomorrow as a sole trader. You know, you've got full control after tax. It's all great. Very inexpensive to set up. You go to your accountant every year. He just adds your business onto your tax return. All done. Not an expensive structure to set up and to run. Disadvantages, of course, is that you're liable for all the debts of the business. So if something happens to one of the customers in your business, you get sued. You. Your assets are on the line, you know. Very hard to transfer ownership in that sort of situation. Difficult to raise finance. Financiers don't like to do business with a sole trader. You know, it's a hard thing to do that. You don't get any tax concessions. You know, when the government talks about giving tax concessions to small business, not these guys. You actually have to be a small business, meaning a company, a small proprietary limited company. That's what they're talking about. They're not talking about the thousands and thousands of sole traders that are out there. They don't get any tax concessions. Yeah, you get very few tax concessions, and you know there's a whole lot of problems that you get into with PAYG, super, and work. But we'll talk about that later. Partnerships, again. Partnerships, easy to set up, usually involve a trust a partnership agreement. You get greater assets to skills and money, don't you? Well, quite often you go into a partnership, someone brings skills that you don't have, very clever. Someone brings assets, and so that you can build something a little bit bigger than if you were doing it on your own. So, and there's more people to share the losses, you know. When there's a loss, actually you only cop in half the loss. The other partner has to take the other half. They're good, easy things to set up to a large extent. Some of the disadvantages is that one I said before is you're liable for the debts of the entire partnership. So one of the partners goes bad, has trouble, signs up, drives off with a Mercedes, drives it off a cliff or whatever, you're up for that debt. They don't bother to go and chase him, they don't need to. You're sitting there, you're in a nice home, looks good enough to sort of get our car back, so they sue you. And you say, but I had nothing to do, the guy was a madman. You say, well, bad luck, you're in partnership with him. He's my brother, he's got no choice. There are limitations on the number of partners, but I think it's about 50, so it's usually going to see most of us out. What else? Very hard to transfer ownership in a partnership. You've also got more compliance costs. The partnership has to put in a tax return, and the basic rule of partnerships in business is they don't work. Yeah, that's just how it is. They don't work. So if you understand that, you've got a good chance of making one work. Yeah. So if you go into a partnership saying, now this isn't going to work, so what are we going to do to deal with that? Then you can actually come up with a half-decent partnership. Because what you'll do is you'll have very short-term agreements. In other words, you'll say, we're going to do this for 2 years, and then we're going to sell it to a third party, and we're going to clean up. So everyone's working for an end game. Nothing worse than being locked into a partnership that doesn't seem to have an end, and you're locked into this terrible situation. You're going to have regular meetings, aren't you, where you're going to close the door and say, okay, your turn to yell at me. When you're finished, I'm going to yell at you, and then we're going to try and resolve some differences. So the fact that it's not going to work, you're going to set up certain structures that are going to make it actually work. And you're going to set up key man insurance on each other. You're going to set up a whole lot of things like no wives in the business if you're two blokes. Or if you're two wives, you say no husbands in the business, whatever. But because you don't want to be going into business with your partner's partner. It's hard enough going into business with that guy without going to business with that guy behind it, or the girl behind it. So you have very strict instructions, and you have lists of, this is what I do every month, this is what you do every month. There's a very clear demarcation. So then you have a partnership agreement. They're almost critical to put together. If you're going to go into a partnership agreement, like I say, knowing that it's not going to work, you're going to actually sit down and say, well, how is it going to work to make sure that we can make it work? So you usually have a partnership agreement that has all these sorts of things. The key man insurance is really important because, in the event of some partner being permanently disabled or obviously death, that you get some money to be able to pay out the other partner. So they're completely out of the business. So they get cash, you get the business, and life goes on. So there's lots of stuff to think about there. There's a whole lot of lists. You can download this and think about it yourself. What else? Proprietary limited company. This is where you first create a new entity. You actually create a new entity that gets sued. Here's the first chance so that you don't get sued. Your company gets sued. And remember, we're going to set this company up. Companies can be set up for about $2. So you put in $2 worth of equity. Equity means that's the value of the shares in that company is $2. And the reason why it's called proprietary limited is it's limited. You can sue the company only to the value of its investments. So limited means it's limited by shares, the value of the shares. So if the value of the shares are $2, if someone sues you and they liquidate your business, they get the $2 all to themselves. The whole $2, no discount. They get $2 on the note because you've got a proprietary limited company that's only guaranteeing any debts of the company to the value of $2. So that's why you see a lot of businesses going around and they go broke and they've still got nice houses and boats and they're still living the high life because it's their $2 business that's going down, not them. They are an independent shareholder in the whole thing. They aren't the business. The legal entity called the business is going down the gurgler for $2, but their multi-million-dollar properties and all that are exempt from it because there's no connection between the two. There are a few, and I'll explain when banks know about this. So when you go for a loan from the bank, you say, oh, it's the business making the loan. The bank says, yeah, we know that. But what we'll do is we'll get you to give a personal guarantee of the business. So if the business goes down, we're going to come through and get you a personal asset. So they're pretty clever, aren't they? But unsecured creditors, which are mostly your suppliers, don't have that opportunity. Most suppliers take the gamble that you're going to pay the debts. But at the end of the day, if it goes down, the unsecured creditors get nothing. That's how it works. And there's a whole lot of businesses, a lot of business people that actually deliberately take a company down like that. All the debts go away, and then they open the next day under a different company because they got rid of all that. They didn't have to pay the $100,000 in creditors. They actually still got that money to go and open a new business. So there's a lot of nasty stuff, and the government's looking at trying to stop that. Sometimes you'll see a company that's called just limited. It doesn't have the PTY in it. That means that it's a public company. That means that it actually trades its shares and raises money from the public and sells its shares on the stock exchange. That process to go from a PTY to an LTD or a limited company is quite expensive, probably $500,000 at the low level to convert your company to that. So I've been through a few of those things. They're called public floats or initial public offer. You'll sometimes hear that. You know, where Facebook went from a private company, PTY, to a public company, and Mark Zuckerberg is now worth.
Have you been involved in that?
Not Facebook.
No.
In that, yeah, public float, yeah. We did one when I used to work for a merchant bank. So that's the difference you'll see there. So legally, tax-wise, accounting-wise, it's a completely separate entity. You then take on a different role. You become the investor, you become the shareholder, and you become the manager, but the actual business is a separate entity. And if you only put $2 in terms of equity, which is what all of us are going to suggest you do, obviously you're going to put more money into the business, but how you put that in is loan funds. So Peter Baskerville puts loan funds into that business, and I put on it, the caveat that I do is that it's payable on demand. So when I want that money, I say to the company, a separate entity, you have to pay me. Now, it just so happens that the director of the company is also Peter Baskerville, and he writes out the cheque to Peter Baskerville, the individual, and I get the money. And then I leave the $2 in because by law, that's the investment in the company, and then I say to the creditors, go get it. Fight over the $2, see how you go. What can a proprietary limited company do? It can sue and be sued. It can sue people in the company. So it's not Peter Baskerville suing you, it's something proprietary limited suing you. The company can own property. The company can enter into contracts, lend, borrow money, operate its own bank account. It can be bought and sold. And it's all controlled through ASIC, Australian Securities Investment Commission. All of that's controlled through there, and you've got to, every year, keep ASIC informed as to who the directors are, where you're trading. You've got to do a fair bit of public disclosure about your business operation. How can you start a company? You can actually go and fill out all the necessary forms, go down to the ASIC office in the town. I haven't ever registered a company here. We didn't do it anyway, we went through our accountant. But you can go and do that all separately, or you can go to a place like this, which is Patricia Holdings. It's hard to believe that this company here is actually the company that creates what's called shelf companies. How does that work? So many people, every year, there's thousands of people that want to start a new business and start it as a new company. Solicitors and lawyers know that. Now, to do it as a custom thing, hi, welcome, what name do you want, let's fill out some forms and go through that whole process, it might cost about $1,200 in fees and accounting fees and legal fees, yeah? If they did every customer that wanted that thing, that's how much it would cost. So a couple of accountants and lawyers got together in Patricia Holdings, and they every year go and register 10,000 companies in one big swoop. They have, you know, they come up with all these names. They themselves, the accountants and the solicitors, become the shareholders and the directors, and they do it all in one go because then it's just one big, one trip to the ASIC. It's one, you know, one copy and paste, copy and paste, copy and paste to create all the documents. And then they have what's called then shelf companies. They are real companies. They're not trading, but they're registered companies. They're alive. All you've got to do is change the shareholders at least, the directors, and then sometimes the name if you want to. You don't have to. And that's what you do, and then it's yours. So when you go to the accountant's office, usually it's the accountant that's doing it. You just, they resign as the director, you take on a director, they resign as a shareholder, you take on as a shareholder. You walk out as with the company. It's actually tangible under your arm. You walk out with the memorandum and articles of association. It's your, from that moment on, it's your company. It's called buying a shelf company. And so the price they sell them for is about $700. So instead of paying $1,200 to set up a company, you can actually go and buy one as a shelf company. So it's ready-made, and then you change the others as you see fit. It still comes down to, if there's more than two of you in the business, you don't do a partnership agreement because you're not partners. You're actually shareholders of a company. So you still do a shareholders agreement. So you still should sit down, if you're smart, sit down and say, right, how does this work? Who gets what? Who does what? How do we have meetings? How do we make decisions? What are we going to do? What's the plan here? Are we going to sell it in 2 years? What are we going to do with key money insurance? So you need to sit down with probably a good lawyer or a good accountant and come up with a shareholders agreement. This is because it's going to go wrong. You know, this is not in case it goes wrong, because it is going to go wrong. So you need to have this in place so that there's a structure to be in place when everyone's being very emotional. If you've got no structure and everyone's being emotional, we're in trouble. So the advantages is limited liability. That means you're only required to meet the debt to the value of your investment in the company, which is $2. So that's your commitment. You know, that's all you have to do. The business can continue. On your death, it's very easy to just pass over those shares to someone else. It's one of those businesses that doesn't have to ever close. It's a business that can just continue to start continue. It's easier to raise capital. Banks like PTY Ltd companies. They do like them. They will ask you for a personal guarantee as well, but that's just how banks make money, or don't lose money, I should say. So it is easier to raise capital and expansion capital. I haven't updated this, but it was for a period of time there where you could open a company and only have one director and one shareholder. I'm not sure that they've, in the past it used to be two. I've got a feeling they might have changed that now, so you actually have to have two directors. Not sure about that. There's greater superannuation benefits, and one of the beauties of the company tax is you tax at 30%. That's it, flat tax. It's not, you know, you as individuals. All those other ones, when you're a partner, when you're a sole trader, as your income goes up, it just goes up that scale, right up to 48.5%. So there's a point at which trading as a sole trader is not smart, because the profit you're making, if you were a company, you'd only be paying 30%. You wouldn't be paying 48.5%, you'd actually only be paying 30%. And so, hey?
Why is that?
It's just governments attracting. It doesn't work in the early days. Up to about 120,000, you're still better off being an individual, because you get 18,000 free as an individual. You don't get that with a company. If you make $10, the government wants 30% of it. So there's no threshold. So it's one of those things. But once you get to about 120,000, around that sort of mark, you're better off turning your private. You're better off sole trading business into a company, because then your tax liability is much lower. It's an incentive that the government does to try and, you know, they don't want to be taxing businesses, because businesses actually create not only wealth for the shareholders, they also create wages for you guys, don't they? So they do like the idea of, because for every business that pays 30% on its profits, it's also paying PAYG tax for all of its employees. So it's a good income earner for the government. Anyway, and also they're competing globally, because there's some countries, you know, there's tax havens like Vanuatu where you don't pay any tax.
Can I just ask, if a company loses money in 1 year, next year they make money, are they taxed on that?
Yeah, no, you can carry forward losses. So you lost 100 grand in your first year, you made 100 grand in your second year, you actually don't pay any tax, because the 100 grand losses gets carried forward, and it offsets. So that's one of the good things. If you've got a tax loss company, in fact, if you've got a company that's lost all this money, it's actually valuable to people. People will buy a company that's actually got losses in it, because when they buy it, they can then offset those losses. So funnily enough, companies with losses are actually very, very valuable on the market. Some disadvantages: a lot of compliance. You know, you've got to have an accountant in there at least. They're expensive structures to establish and operate. They do require meetings. They do require annual returns. There's a whole lot of things you need to do. You do have to create a separate tax return for your company and a separate one for you as the shareholder. A lot more